Experts say confiscation is ancient history, yet central banks themselves are buying gold at record pace. So why do they want it while you are warned not to? With prices climbing and rumours swirling, the idea of confiscation starts to sound less like fantasy and more like a what-if moment. In this video, we explore what that means and how you can respond. Gold confiscation may sound like a relic of economic history, yet whispers of its return persist in bullion circles. It remains one of those subjects that refuses to die, cropping up in newsletters, at coin shows and across YouTube channels. The very word conjures April 1933, when Roosevelt's Executive Order 6102 compelled Americans to surrender mostly privately held gold in exchange for $20.67 per ounce. That was a forced trade, not a midnight raid, but it left an indelible mark on the relationship between governments and gold owners. Within months of the surrender program, the US government revalued gold to $35 an ounce, effectively devaluing the dollar and gifting itself a tidy windfall. To the individual saver, this looked like daylight robbery dressed in the robes of legality. To Washington, it was a tool of macroeconomic stabilization during a deflationary depression. Confiscation was less about stripping citizens of treasure than it was about manipulating the money supply at a time when every dollar had to be backed by metal. Now, it is worth pausing on that trauma. The penalties for disobedience in 1933 were severe, a $10,000 fine or up to 10 years in prison. Some individuals did resist, but most complied, either out of fear or patriotic duty. More than 600 tons of gold flowed into federal coffers. Private gold ownership remained restricted in the US until 1974, when Gerald Ford signed legislation allowing Americans to once again hold bullion freely. For 4 decades, the lesson lingered. Gold in private hands could be declared illegal at the stroke of a pen. This precedent has fed conspiratorial thinking ever since. And let us be clear, conspiracies thrive because they contain a grain of truth. The US government did confiscate gold. The question is whether it could or would ever repeat the exercise. What is often forgotten is that confiscation in the US did not arrive at the start of the Great Depression, but at its culmination. Those who still held gold had preserved wealth, while others were wiped out. Importantly, it was not outright theft. Holders were given paper dollars, albeit at a rate that became disadvantageous after the government's swift revaluation. In the 1930s, gold was not merely an investment asset, it was money itself to the government. Americans carried gold coins or gold-backed certificates in their pockets, and every dollar in circulation was tied to a fixed weight of metal. Under the rules of the gold standard, the government could not expand the money supply without first securing more bullion. This made confiscation and revaluation essential tools for Roosevelt. By forcing citizens to exchange their gold for paper and then raising the official price, Washington devalued the dollar, fought deflation, and created the room to expand credit, all without openly abandoning the gold link. Now, fast forward to today, and the logic has evaporated. The United States left the gold standard in 1971, and money creation is now a digital exercise. Central banks can expand liquidity with a keystroke, deploying quantitative easing, rate policy, and balance sheet tools. They do not need to confiscate anything to create new dollars. And that is why confiscation in the Roosevelt sense has become largely redundant. Equally important is the shift in who holds gold. In the 1930s, it was widely circulated as everyday money, and today private ownership is far narrower. Surveys suggest that only a small fraction of US households own any bullion at all, and in most advanced economies, the figure still sits in the single digits. The bulk of gold is concentrated in central bank vaults and specialist portfolios rather than in ordinary citizens' pockets. So with so little gold in the hands of the public and so many alternative ways to manage money, the systemic incentive to confiscate simply no longer exists. Now, what has changed is the form of control. Governments no longer need to seize assets physically. They can tax, they can regulate, and they can surveil far more effectively through the digital money system. The encroachments are quieter: capital gains reporting, transaction monitoring, and cross-border data sharing. It is less about prizing coins from your palm and more about ensuring the Revenue Office gets its slice when you sell them. Now, of course, the US episode is not unique. Several governments have intervened in the gold market, sometimes stopping short of confiscation, sometimes not. Australia's 1959 law gave authorities the right to seize gold if deemed necessary to protect the currency, a power that cast a very long shadow, even if rarely exercised. In the UK, currency weakness in 1966 led to restrictions on private gold ownership, banning citizens from holding more than 4 gold or silver coins, and preventing private imports, measures that lasted until 1979. And then you have the Netherlands. During the Great Depression, they imposed tight controls on ownership and movement, making gold difficult to hold or trade. And in the most aggressive form, of course, we had Nazi Germany, which systematically plundered gold from occupied central banks and private citizens alike, stripping vaults across Europe. Now, what unites these episodes is context: crisis, war, currency collapse. When the stakes were existential, governments acted at the expense of individual property rights. For today's investors, the lesson is sobering. Outright confiscation is rare and politically fraught in modern democracies, but history shows that no jurisdiction is entirely immune when economic survival is at stake. So why then does the fear persist so strongly in the bullion world? Because it sells. The idea that only rare or numismatic coins are safe from confiscation is often used to justify inflated premiums. Fear of seizure remains a handy marketing tool in an industry where margins on antique coins dwarf those on bullion bars. So investors should recognize the difference between legitimate historical precedent and the manufactured panic designed to prise open wallets. Now, this is not to dismiss investor anxieties. Distrust of government is hardly irrational. But we should be clear, in 2025, confiscation of the Roosevelt variety is improbable. What is more probable is wealth erosion through inflation, financial repression, or stealth taxation. The enemy is less likely to be a knock at the door and more likely to be a clause in the tax code. Wealth destruction usually shows up in paper markets long before governments consider gold restrictions. Bank failures, stock market collapses, or currency debasement, they tend to punish savers first. And of course, we have to acknowledge that there is a new wrinkle in the conversation: talk of US gold revaluation. The Treasury still carries its official gold reserves at just over $42 an ounce, a price frozen in time. At today's market price, over $3,300, this undervalues the hoard to a comical degree. Were Washington to revalue its holdings to reflect market reality, it could book a paper gain of over $750 billion. So why does this matter? Because America's fiscal position is under strain. Debt ceiling dramas recur with exhausting regularity. Proposals like the Bitcoin Act, which links gold revaluation to the creation of a strategic Bitcoin reserve. This shows how creative lawmakers are becoming. President Trump has mused aloud about auditing Fort Knox, fueling speculation that gold might once again play a central role in US finance. In international precedent, central banks have used gold revaluations to shore up balance sheets. Revaluation does not involve moving bars around. It is an accounting maneuver, assigning a higher dollar value to existing reserves. It does not pay off debt, but it can improve the optics of solvency, ease liquidity constraints, and provide temporary fiscal breathing space. So does revaluation mean confiscation risk? Well, not directly. A revaluation changes the price at which the government values its gold, not the ownership of yours. There is no legal mechanism tying Treasury accounting to private holdings. The risk is not that your coins will be called in, but that the political conversation about gold's role in the system intensifies. And here is where various theorists find fertile ground. If gold suddenly regains official importance, could Washington decide that more gold is better? Could it revisit 1933 under a modern guise? Well, on balance, for me, the answer remains no. The global economy is no longer organized around a gold standard. Confiscation would not meaningfully improve US finances, but it would irreparably damage investor confidence and trigger capital flight. In short, it would be counterproductive, to say the least. However, what investors should watch closely are indirect forms of control. A revaluation could bring calls for higher taxes on gold profits, tighter regulation of storage facilities, or reporting requirements on international transfers. Governments today prefer subtle erosion to blunt confiscation. So during periods of sensational headlines, these inevitably provoke anxiety among investors. Some may be tempted to withdraw their bullion from vaults at the first sign of political maneuvering and panic. But history and best practice both suggest that a measured approach is far safer than a hasty reaction. Transparency is the first safeguard. Reputable vaults operate with round-the-clock surveillance, biometric access, independent audits, and comprehensive insurance. Investors should take advantage of these safeguards, requesting statements, certificates, or even in-person inspections to build their confidence. Education is equally important. Keeping coins under the mattress may feel reassuring, but it exposes owners to theft, fire, or the voiding of insurance policies. Professional storage provides not only physical security, but also legal clarity, particularly for assets in retirement accounts where the law mandates approved depositories. And of course, diversification of storage. This further reduces anxiety. Splitting holdings between domestic and offshore vaults ensures that no single jurisdiction or crisis imperils an entire portfolio. Offshore options are particularly attractive to those seeking a hedge against local political instability. And finally, communication matters. Dealers and vault operators should be proactive, providing calm, factual updates during turbulent times. Clients need reminding that vaults are designed to withstand crises and that impulsive withdrawals can create far greater risks than they resolve. The best antidote to panic is information. By understanding the security, the transparency, and resilience of professional storage, investors can keep their bullion where it is safest, inside a vault, not under a mattress. And at GoldCore, we manage these risks every day for our clients. Our vaulting network spans multiple jurisdictions across the world, and importantly, it costs the same to store your gold in Zurich, London, Texas, or Singapore as it does anywhere else. Because we are directly connected to the wholesale market, clients can buy and sell quickly at competitive prices without the delays or markups that often plague those retail transactions. And behind the scenes, our risk team constantly monitors geopolitical and regulatory developments. In 2019, for example, when concerns mounted about Hong Kong's future under increasing Chinese influence, we acted swiftly, relocating clients' bullion out of Hong Kong vaults and into safer jurisdictions, always with the owner's permission. It is this combination of global reach, liquidity, and proactive risk management that allows investors to hold gold with confidence, knowing that their wealth is protected against both market turbulence and political surprises. It is worth restating the real risks to investors. First, inflation. Governments everywhere are eroding purchasing power as a matter of policy, using money creation to soften the pain of debt. Secondly, taxation. Capital gains, wealth taxes, and transaction levies are easy tools for fiscal authorities. Third, financial surveillance. The shift to digital payments and central bank digital currencies means private assets like gold stand out more in a world of monitored transactions. Confiscation is unlikely, but repression is real. The danger is not the loss of your gold, but the slow bleed of its value through policy choices. So let's give you some actionable advice for investors. What should you do in 2025? First up, diversify storage. Spread your holdings across jurisdictions. Keep some bullion at home if you want to for liquidity, but definitely some in secure domestic vaults and some in allocated offshore facilities. Political risk is always localized. Spreading holdings dilutes exposure. Next up, stay paper light. Exchange traded funds, ETFs, offer convenience, but also counterparty risk. If you hold gold for insurance against systemic failure, ensure you own specific bars or coins in your name. Then maintain meticulous documentation. Receipts and contracts prove ownership. In any legal or regulatory dispute, documentation is as valuable as the metal itself. And monitor political flashpoints. Debt ceiling showdowns, fiscal crises, or radical legislation are moments when governments might reach for extraordinary measures. Gold often plays a role in these debates. And ignore sales-driven myths. Dealers who insist that only rare coins are safe from confiscation are selling fear, not fact. Buy what aligns with your goals, whether low premium bullion for weight or numismatics for history, but do so with clear eyes. Of course, there is a deeper critique here that is worth making. The very fact that confiscation remains part of the bullion industry's lexicon says much about the fragility of trust in modern finance. Investors suspect, often rightly, that governments will sacrifice citizens' savings before admitting policy failure. Inflation is simply confiscation by stealth. The debate over gold is a debate over the honesty of money itself. Revaluation rumours add fuel to this fire. If Washington decides it can solve fiscal headaches by repricing its own hoard, well, what does that say about the supposed solidity of the dollar? And if central banks are quietly hoarding gold, as they are today in record volumes, why are ordinary savers discouraged from doing the same? The hypocrisy is glaring. So I will conclude with this. The 1933 confiscation was context specific, legally sanctioned, and rooted in a gold standard that no longer exists. But the myth persists because it resonates with deeper truths about the precariousness of fiat money and the willingness of governments to bend rules in a crisis. Revaluation rumours remind us that gold never disappears from the political imagination. It remains the asset of last resort, the anchor of governments return to when trust frays. For investors, the lesson is not to fear confiscation, but to prepare intelligently, hold physical gold, diversify custody, keep impeccable records, and track political developments with a skeptical eye. Gold remains what it has always been, a form of insurance against the dishonesty of paper promises. Governments may not confiscate it again, but they will certainly covet it. And that is reason enough to make sure you own some. So if you're worried about any of this and you're thinking about heading for the exit, click on the link below and download the exit plan now.